Everyone, it's Zach back with a new mortgage video. Hope you all had a happy weekend. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. So on today's Monday mortgage market update, I'll talk a little bit about last week, especially the Fed rate decision, and I'll talk a little bit about today because there's been some movement. I want to explain what's causing that because it's been kind of a recent trend. And then I'll talk about this week and what's likely to move the needle. So last week, the big thing was the Fed rate decision on Wednesday. Fed once again chose to maintain the current interest rate, which was expected for the past 2 months. But what was more of an uncertain is the Fed dot plot projections, which are these quarterly projections that each member of the Fed board votes on for things like the Fed funding rate, GDP percentage, inflation in terms of PCE. And so that was very much an up in the air thing. A lot of people thought that with all the uncertainty, and especially with Jerome Powell mentioning a few weeks ago that while there was so much uncertainty, they would likely not cut rates any further. A lot of people thought they would lower their projections for rate cuts in 2025. They did not. The majority of the Fed members still are expecting 2 rate cuts this year, which is the same as the consensus in December at their last meeting where they released a dot plot. The other notable things from the dot plot were expecting lower growth in terms of GDP and expecting higher inflation in terms of both core and headline personal consumption expenditures. So what was, I think, noteworthy in the press conference afterwards is that Jerome Powell talked about that balancing out in the Fed's mind. The overall result of the meeting was some positive movement in mortgage rates. Now today, there's been a reversal. We've seen an uptick in mortgage rates, and there's not really any economic data to explain it, but the stock market has improved today. So this has been a trend the past couple weeks where on days where there's no major ticket items on inflation or jobs, which are typically the reports that move the needle for mortgage rates, if there is a big movement in the stock market, the opposite effect happens with mortgage rates. So today it is the latter. And it sounds like largely because of Trump saying that probably going to pull back tariffs in April, which is an interesting thing because there's kind of this balancing act between are tariffs going to scare people away from not spending, which would be a good thing probably for mortgage rates, causing less inflation, or are tariffs going to drive prices up? So today the reaction seemed to be positive for the stock market, but in general, I don't think there's going to be a long-term shift in mortgage rates caused by the stock market. I think this is really just a result of so much volatility where things that aren't typically market movers are getting latched onto as the market tries to come to terms with what's going to happen. And again, with even the Fed, they don't know what's going to happen. They're projecting some higher inflation. Obviously, some of it was due to tariffs. So in theory, if there are lower or no tariffs in the end, we've had this multiple times where the Trump administration is saying we're going to have these really aggressive tariffs and then pulling them back. If the end result is no or little tariffs, you'd have to think that that projection, which factors in tariffs, should be an over projection, and that should be a positive thing. But for today, it has not been. Now, the big report that's coming out this week is personal consumption expenditures, or PCE. And that's the Fed's preferred inflation metric. That's the one that they track on their dot plot every quarter. So again, the Fed is expecting an uptick in inflation. The last PCE reading that we had was essentially at the Fed's projection from their December meeting. We were there at 2.5% for the headline number, and just above the core number at 2.6% versus 2.5%. So in a normal environment, if you're expecting inflation to continue going down, which it has the past couple of years, then we should be ahead of schedule. However, with tariffs and a lot of uncertainty, they're now expecting that number to jump up. Now, this month, how much the things like tariffs and policies are going to trickle into that data, it's not clear. What is clear is that this number, PCE, is even more than normal being fixated on by the investors that trade treasury bonds and mortgage-backed securities, because we saw earlier this month consumer price index and producer price index, which are two other inflation readings which have components that trickle into PCE. The overall numbers for those two figures came in better than expected, lower. However, the little components that trickle into PCE came in higher than the previous month, and the market reacted negatively to those two reports. So we'll see how it turns out on Friday, but this is definitely an important report, even more than normal right now. If you have any questions or comments, feel free to shoot them below, or you can always call, text, or email me. But thanks for tuning into this video, and I will see you next time.